Welcome. You know, when you start looking into stocks, you get hit with this wall of alphabet soup. EPS, PE, all this financial jargon. But what if I told you that just two of those little acronyms are the key to answering one of the most important questions in investing? Well, today, we're going to demystify them. Let's dive in.
So, we've all been there, right? You find a company you absolutely love. Their products are amazing, you believe in their mission, but that's only half the battle. The real question, the one that makes or breaks an investment, is this. Is the stock itself a good deal right now? Because a fantastic company can still be a terrible investment if you pay too much for it.
To figure that out, we have to cut through all the market noise, all the hype, and get right down to one crucial thing. How much money is this company actually making? And that's where our first tool comes in. It's called EPS, which stands for earnings per share.
So, what on earth is earnings per share? Okay, imagine a company takes all the profit it made in a year and decides to split it up like a giant pizza. Every single share of stock gets one slice. EPS is simply the size of that slice. It tells you, in plain dollars and cents, how much profit is backing up each and every share. It's the bottom line truth.
And you might think the math is going to be complicated, but it's not. It's incredibly simple. You just take the company's net income, that's their total profit after all the bills are paid, and you divide it by the total number of shares out there in the world. That's it. Total profit divided by total shares.
So what's a good EPS? Well, sure, a higher number is usually better. It means more profit for each share. But you know what investors really get excited about? Growth. Seeing that EPS number climbing steadily, quarter after quarter, year after year, now that is a beautiful sign of a healthy, thriving business.
Okay, so EPS tells us what the company is earning. That's the reality. But how does that reality connect to the stock price, which can feel, a little disconnected sometimes? Well, there's a bridge. And that bridge is our second metric, the PE ratio.
The price-to-earnings ratio, or PE, is, well, it's pretty much exactly what it sounds like. It directly compares the price of a stock to its earnings. Think of it like the market's official price tag. It answers the question, how much are people willing to pay today for every dollar of profit this company makes?
And again, the math is super straightforward. You just take the current stock price you see on your screen and divide it by that EPS number we just figured out. See how they connect? You can't get the PE without the EPS. Price divided by earnings. It's right there in the name.
So you do the math and out pops a number. Let's say it's 20. You'll often see it written as 20x. So what does that actually mean? Is 20 good? Is it bad? What's the story here?
It's simple, really. A PE of 20 means that the market, that's all of us, investors everywhere, is currently willing to pay $20 for every one single dollar of that company's profit. So it's not just a random number. It's a mood ring for the market. It tells you exactly how excited, or maybe how skeptical, people are about that company's future.
So, a really high PE usually means investors are betting big on future growth. They're willing to pay a premium now because they think those earnings are going to explode later. On the flip side, a low PE might mean investors are feeling a bit down on the company, or, and this is the exciting part, it could mean you've stumbled upon a hidden gem that the market is undervaluing. It tells a story about expectations.
Now, this is maybe the most important rule of all when it comes to PE. Context is everything. You have to compare apples to apples. A PE of 35 might be totally normal for a fast-going tech company, but it would be insanely high for a slow and steady bank. They're just different kinds of businesses. So you always have to check how a company's PE stacks up against its direct competitors in the same industry.
Okay, let's add one last crucial layer to this. When we say earnings to calculate the PE ratio, are we talking about the earnings the company already made or the earnings we think it's going to make? This is the huge difference between what we call the trailing PE and the forward PE.
It's really two sides of the same coin. The trailing PE looks backward. It's based on the hard facts, the actual proven earnings from the past 12 months. The forward PE, on the other hand, looks ahead. It's based on an educated guess, a forecast of what analysts expect the company to earn over the next 12 months. So one is based on history, the other is based on hope.
So which one should you use? Well, the smartest investors look at both. You absolutely want to see what the company has actually done. That's your reality check. But you also want to know what the market thinks it's going to do. Together, they give you a much, much fuller picture of the investment story.
All right, let's bring it all home.
What started as a couple of confusing letters, EPS and PE, has now become a powerful basic toolkit. You can use this to start analyzing pretty much any stock you're curious about.
So let's recap really quick. First, we look at EPS. That's the company's real hard and fast profit for each share. Then, we use the PE ratio to see the price tag the market has slapped on that profit. We look at the trailing PE for the history and the forward PE for the expectation. And we always remember to compare that PE to others in the same industry.
So the next time you're looking at a stock, you can ask yourself a much smarter question. By looking at these numbers, you can figure out, am I paying a fair price for this company's proven history? Or am I placing a bet on its promised future? Knowing the difference is what turns guessing into investing.